Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup. This is for the trading week ending November 6, 2020. I'm Preston Brent. Thanks for tuning in. Remember guys, don't be a rat brain trader. You want to be the red striped zebra. And this week's theme is we got to continue to water the money tree. Before we jump into anything, let's just kind of take a look at where the index has fared for this past week, this crazy U.S. election cycle, presidential election cycle week. So if we just look at it in kind of a snapshot, looking at all the major indices, um, you're going to see here that we've got the most of the markets. In fact, every market, every major market this week was up in the green. All right, you can see the Dow, S&P, Nasdaq, Russell up very strong, all of them over 5%. The strongest performer for the week was Nasdaq, up 9.01%. Talk about that in a minute. Russell was pretty strong as well. In the red year to date, still the Dow just below waterline, 75 basis points, and the Russell is down 1.44%. And then on the right hand side, you can see the PE trailing 12-month ratio is 39.81, huge. And the forward PE ratio is still pretty large at 25.15. It's about 36% reduction from the trailing 12 months, but it's still elevated. Primary reason, you can see the 10-year Treasury yield is closing out the week at 82 basis points. The dividend yield for the S&P is at 1.74, so that gives us a spread between the two of 92 basis points, roughly. And you can see that continues to channel money into the U.S. markets, obviously. And then the current VIX, it fell about 38% this past week from last week's close. It fell 34%. It went from 38.02 down to 24.88. So the volatility is starting to come in now that we've moved through the U.S. election. And then the best sector performer for the week obviously was technology. It was up over 10%. XLK was, as evidenced by the Nasdaq just blowing it out this past week. Worst performer also managed to finish in the green. So all sectors were in the green this week. The worst performer, energy, finishing about up 88 basis points. And then annual performance, you can see technology's been in the lead pretty much all year, coming in this end of week at 33.98%, so almost 34%. You can see energy coming in at a minus 49.29%. And then let's look at the rest of the planet. You can see everybody was in the green. Everybody had pretty much a strong week for the week. Still a lot in the red, though. Over in London, the FTSE, which represents Great Britain, really, it's still in the red in a bear market, 21.64% down. CAC 40 is still in a serious correction territory. Remember, last week they were in a bear market. They moved out with that strong finish this week, up almost 8%. And they're down 17.02 for the year. The German index, also a strong week, almost up 8% for the week, but still down 5.8% for the year. And then the Nikkei and China, both Asian markets, both in the green for year to date and weekly. The Nikkei moved into the green this week with a very strong and unusually strong for Japan, finishing up 5.87%. And then you can see the Hang Seng is the only Asian market down year to date, and primarily because China's just putting a ton of pressure on them. So I think Hong Kong markets are going to be forever changed as they come more and more under the Chinese rule there. So basically, net, there is a lot of green on the screen here for the markets this past week. Now let's take a look at, the primary reason why. And if we look at the markets, let's just look at the index performance as I just reiterated here. We had our largest weekly rally since April of this year. And as you guys remember, March 23rd were the lows in the market this year because of COVID, and then we just rallied strong. This is the strongest weekly rally since April. Even though we've got there's a lack of a clear winner from the Tuesday's election. All the markets give Biden about a 98% chance of just bringing this thing in. And regardless of your political affiliation, we got to play the markets the way the markets line up. And right now, that's the way it's lining up. And it also appears that the Republicans are likely going to retain control of the Senate. There's still a couple of runoff elections, but it looks like they're going to maintain control. So it gives the investors this week, from a financial perspective, almost like a Goldilocks scenario, where the markets were anticipating additional fiscal stimulus, whether Trump or Biden won. But now, if the Republicans retain control of the Senate, there's going to be limited tax increases, because the blue wave was really more of just an eddy. It never really came in like the markets were forecasting. So the Senate would retain control with the Republicans, and in the U.S. Congress, the Democrats lost 9 or 10 seats. So it's going to make it harder for them to even do some of their policies, even though they're still in control right now. So it's a Goldilocks market for the market here. And like I said, tech heavy Nasdaq was the best performer, because technology stocks tend to get hit hardest with any tax moves. Now, if it looks like in these runoff elections in December, January timeframe that the Senate goes into the hands of the Democrats and Biden is affirmed the winner after all legal challenges are exhausted by Trump, then you can expect the technology to pull back a pretty good little bit. But right now, that's not what the markets are forecasting. So this week, technology, NASDAQ did very good. Small cap Russell did better than the broader market. So we're getting some of that risk on kind of environment. Okay. So that's a little bit about what we're seeing this week as a result of the election. And from a central bank perspective, our own Fed chair, Jerome Power Ranger Boom Boom Powell, came out and basically said they still have monetary tools that it can deploy to boost the economy, but he's still reiterating that the economy is still at big risk unless there's a fiscal stimulus package coming. And I suspect now that we're through this election, even McConnell, he's still the Speaker of the Senate. He runs it. Has indicated and voiced that we need to get a stimulus package out before the end of December. All right. So remember, they got a runoff election in the Senate. So I suspect the markets are going to anticipate that and run up and rally. November and December traditionally are strong rally points for the markets, particularly after an election, no matter who wins. So we can expect to see some movement higher. Um, I was expecting a little bit further of a dip than we got. After in about another, I would say 2 weeks, I would expect a little bit of a pullback down to around 3,400 in the markets. You know, we closed the week at 3,510. 3,500 is a key level for us. I'll show you the charts in a minute. I wouldn't be surprised to see us move to 3,400, but I do believe we're going to take out our all-time highs at 3,587 in the S&P futures. And move up to the 36, 3650 area. If they get that stimulus done, then we can run up even more. All right, so just understand that's kind of what I'm seeing. Boom Boom Powell has also indicated that they've got more tools at their disposal, but they need fiscal stimulus. He's open to the possibility of expanding their purchases of long-term securities. Remember, they've got a QE program running right now that people don't realize. They're spending $80 billion a month on the short end of the U.S. Treasury market, keeping interest rates low. Not as much on the back end side, which is widening the yields. Okay, although we're seeing that come in a little bit in that reflation bet now that Biden, if he's in, is going to be kind of handcuffed, and they're not going to do as much stimulus. So the reflation trade is kind of off the table a little bit, which pushes longer-term interest rates down. But with all of that buying on the front end of the curve by Boom Boom Powell, that's going to keep the yield curve fairly elevated, which is better for the banks. But we're going to see how that plays out. Also, the Bank of England this past week came out, and they increased their buying program by an additional 150 billion British pounds. All right. They moved it up to almost 900 billion pounds total. So, you know, just continue to water that money tree. That's what we're seeing right now. That's going to keep the markets running until some kind of COVID vaccine or stronger therapeutical drugs come out there to battle this thing. Okay. So that's a little bit about what we're seeing with the central banks. And then finally, with the economic data we did get unemployment moving down to 6.9% from 7.9. We did see a better than expected 638,000 jobs last month, better than the anticipation. It's not the big move lower that some wanted to see, but it's still an improvement, driving the unemployment rate down. So steady by steady, we're moving better and better. Now, one fly in the ointment is over 100,000 new daily cases of COVID nationwide was reported. Some hospitalization rates are going up, but it seems the death rate, which I measure and I think is the most important number, is going down, and the treatments by the doctors in the hospitals seem to be getting better. So that means the duration of a hospital visit, if you're unfortunate and you have to go, should be shorter, okay, or could be shorter. So this widely anticipated fall wave of a pandemic is still causing some U.S. states and municipalities here to add new restrictions on mostly service businesses, bars, restaurants, some consumer businesses. It could slow down some of the improvement we've seen in the labor market. We're also seeing that in Europe as well, which is why Europe has still one country in a bear market, which would be Great Britain, and France, which is another big market, still underwater, over 17% for the year, and the DAX over 5.8% for the year. So we're not out of the woods yet, but a lot of volatility has been just shifted out of the market with this election, even though there's still a lot of uncertainties there, which will probably play out for another 30 or 40 days. Let's go take a look at the charts here. What I'm going to do is I'm going to shift the screen over. And let's move it over to right here. Okay, so what we're going to look at is a daily chart of the E-mini S&P 500 futures. I'm going to wait for it to paint on the screen for you. And what you're going to see here is this blue dashed line is where we closed in 2019. Okay, so you can see it's well above the blue line. So that's why we're up year to date about 8.63% right here. Okay, now I want you to notice this chart. Certain stocks have higher weightings to the S&P E-mini futures value than others do. It's not equal weighted. But if we look at an equal weight S&P, meaning each stock carries 1/500th of the value versus something like Apple, which accounts for over 14%, 12 to 14% of the entire valuation of the S&P E-mini futures, or just tech, which accounts for 23% of this. Let's just look at everyone on their own, and you're going to see a completely different picture. If we look at the equal weight, you're going to see here that look at where we closed last year, and now look at where we are right now. We're below zero. So we're not getting the participation that I would like to see in all the stocks in the S&P. Now, it's typical when you get towards the end of a bull cycle, you get fewer and fewer stocks that are, leading the charge higher, and their cap weighting to the S&P takes on a bigger role, hence a greater influence in the movement of the S&P. But you can see here on this equal weight, we're still below zero. So just understand that. Now, for our members this Sunday evening, I'm going to go into what I see are some shifts in the market coming, and I'm going to lay those out for you. If you're not a member of our group, I highly encourage you to come in. We've had a good year this past year. We were calling all the major turns in the market, and I put out a list of things you wanted to get in for our members in early April, and every single one of them have just done very well. And in March and April, no one wanted to touch it, but we jumped in and it's done very well. So this is what I'm seeing on the equal weight right now. So just bear this in mind, okay? If we come over and we look at Bitcoin has made a huge move. It's broken out. It's coming up to my resistance area of 16,400. I think Bitcoin has further to go. But it's going to find a little bit of respite here before it pulls back, and it is going to definitely be worth a buy on the pullback. Okay, for those of you Bitcoinites out there, it's just going to continue a slow march higher. Now, if we come over here and we look at volatility, and I'm going to show you just how far down it's come in a very short period of time, You can see here once the election was done, I mean, just on the 29th of October, a little over a week ago, the VIX was up over 40. Now we've closed the week at 24.86. Once we've got a president officially in and a concession by the other side, depending on how the laws work or the legalities work out, and then we get everything all firmed up, you'll see the VIX slowly drift back down again, okay, until a major event coming up, which I'll talk to our members about on tomorrow evening. Again, if you're not a member, I highly encourage you to come in and check us out, because we take a global perspective on the markets, because money does flow globally. It doesn't just stay within the borders of the U.S. We got a lot of money here from Europe and Japan, by the way, which is going to exit and go back to respective countries once a couple of key things start to happen. And when we see those things happen, we've got some game plans in place for our members that you definitely don't want to be long certain asset classes and short others. So looking at volatility, you can see it down now. If we look at the back ratio, the back month skew, notice we've moved into the green. That's a good sign. We were in a backwardation and now we've moved back into the green. And this is the December, January vol futures. So that again shows that we're getting volatility sucked out of the Q1 and Q2 volatility futures market, as we would expect, because they were all elevated based on just how this thing is going to go. Now, if we get a fiscal stimulus package, which I think Nancy Pelosi is going to be dragged to the table, she's not going to have a choice this time. McConnell's pretty smart. They'll work out some deal. It'll probably be spending more money than McConnell wants, but less money than Pelosi. So to me, that would be a win for them, for each political party. However, I think longer term, there's going to be ramifications for the U.S. markets, the bond market, interest rates, and we're going to see certain parameters start to change. But for now, this is what I'm seeing. And of course, if we come down here and speaking of the bond market, the treasury market, if we look at bonds, again, another hard down day here. We moved down, interest rates back up a little bit, over one full handle. It's going to take about a week or two for the bond market to settle in. But understand one thing, the bond market here is going to keep going lower. It is not going higher. And in the interest of a potential reflation trade, which is what we've been under for the past few weeks, actually going back a couple of months, we're going to continue to see that transpire in the bond market, okay? And if we look at interest rates, you're going to see the 10-year right here starting to go back up. It's found support at the 50 EMA, and I think interest rates are going to slowly work their way back up. They've been working their way up since August anyway, all right? And that is what the reflation trade is starting to look like. Higher highs, higher lows. And we're going to continue to see this play out. Now, as long as it stays a steady pace like this, the equity market should be fine. But if we get some fast movements in this, Powell's going to have to step in. Or that's going to be his tendency, rather. I don't think he should, but he's going to step in, I suspect. He's willing to buy further dated bonds. He's already indicated that, which in doing so would drive this further end of the yield curve down, or the interest rates down, which would drive the yield curve down. Okay. So that's a little bit about what I'm seeing here in the bond market. And then, of course, if we come over and look at currencies, the dollar is going to continue its track down. As you can see right here, I've got a target in the US dollar down around 191. I think it's going to come here, find a little bit of support. We may get a little bit of a bounce if we do get some downdrafts in the market before year end. But trust me, guys, it's going lower. And I think trading the dollar to the downside is a better move. Actually, what I had told our members is you need to be long the euro. All right, the euro is going to come back up to my target of around 121. And you can see right in this area here, it held it nicely. We've already climbed back up over the 50 EMA, and you're going to see the euro just continue to move higher. All right. If you don't get into the euro now, a year from now, you're going to wish you did, because it's probably going to be up around 123 to 125. The dollar is going to be even lower. Okay. And that, of course, is going to bode very well for gold. If we come down here and we look at gold, gold right now it's starting to make some moves here. The 50 EMA is flat. The 200 EMA still has an upward trajectory to it, or a vector. That indicates to me that gold can run up to the 1990 area. It's at 1951 now. My target for gold, remember guys, is up around 2200. And if we can get up a little bit higher, there is a strategy that we can play in the gold futures market. Members, I'll review that with you briefly this Sunday evening, which I think is a high probability strategy to just ride gold for another couple hundred points. It's $100 a point. So it'll be a nice little trade for you. Okay. If we come in and we look at the, well, let's stay with the the metals market for a minute. Let's look at copper. Copper, I'm still bullish on. We got long copper back in early April. Some of our members have done very well in this one on this trade. I still think copper is going to go higher, so we're going to continue to play it to the upside. Okay, and we're doing it via an ETF that tracks copper. Freeport McMoran FCX, and it's already tripled in price. All right, we got into it in the low sixes. It's already at 1912. Can you still get into it? Yes, you can. I've got some upside targets here around 23 to 25. I think it's going to continue rocking. The stronger China gets, the stronger the global economy gets, the more infrastructure build out we're going to see, the stronger you're going to see copper. All right. And we got a long way to go here, especially next year. So it's going to be just a long, slow, steady rise in copper. Now let's move down to oil. Oil is going to be up, down, up, down. I don't believe it's going to be able to penetrate my longer term support area that runs from about 37 to about 33.50 per barrel. That's going to be a big support area. So anywhere in here, if it gets into this color bar, selling some bull put spreads underneath, to me in the oil market makes sense. All right. Outside of that, I just don't see oil getting back up near this pivot high of around $44 a barrel, but I do see it holding steady at this level. So flies or unbalanced flies, broken wing flies, or some kind of broken wing put condor or iron condor. Any one of these can make sense. Okay, don't be greedy in those trades though with oil, because you saw what can happen if the markets go to crap in a heartbeat. Okay, oil should also play in the opening up of the industry as well. There are a lot of other things going on in the markets. Members, we're going to go through those in a lot more detail this weekend. If you're not a member, as I said, I highly encourage you to come in and pay us a visit. We're doing well. Got a lot of things coming up. Otherwise, have a great weekend, everybody. Members, I'll see you this Sunday evening for our weekly market watch. Take care, folks. Ciao now.